Has the Dubai boom finally hit its ceiling? Over the last few months, I've had investors come to me convinced this is the start of the crash. And if you've been watching the market recently, you can see why. Some areas have cooled. Supply pipelines are massive, and there's serious talk about bubble risks in market reports. I've spent years working inside Dubai real estate, tracking its cycles, prices, and patterns, and whenever the market reaches a turning point, whether real or imagined, investors face the same risks. They either move too fast or they freeze completely. So in this video, we're going to break down what the data is really showing and what it could mean for anyone thinking about buying, selling, or holding property in Dubai right now. Before we dive into whether Dubai's boom is actually ending, there's something critical you need to understand about this market. Dubai doesn't move as one single market. What do I mean by that? While headlines scream about the Dubai property market as if it's one unified big thing, the reality is far more nuanced. Different property types and different areas behave completely differently, sometimes moving in opposite directions at the exact same time. And this segmentation is precisely why so many people are getting the current market completely wrong. So let's break down what's really happening beneath the headlines. Most people look at Dubai's supply pipeline and panic. They see 100,000 units plus coming to market and immediately think oversupply equals crash across the board, but that's not how it works. Between 2026 and 2029, Dubai will be delivering over 365,000 new homes. However, 310,000 of these will be apartments and only about 54,000, roughly 15%, will be villas or townhouses. If we look at the annual completions, villas and townhouses average about 13,500 units per year compared to more than 77,000 apartments, and relocating families overwhelmingly prefer villas or townhouses. Even among apartments, only about 15% 3 and 4 bedroom layouts, which means family size inventory is structurally limited. Between 2021 and 2025, Dubai added roughly 450,000 new permanent residents, including 208,000 just last year, a 6% growth rate, creating intense competition for a very limited pool of family homes. And unlike previous cycles where off-plan buyers were mostly short-term speculators, today many buyers are relocating families who plan to partially rent their units when not in Dubai, further tightening supply in villa and large apartment segments. So yes, there's oversupply in certain segments, specifically entry-level apartments in less established areas, but at the same time, there's severe undersupply in others. Let's look at the numbers. Out of roughly 800,000 total units in Dubai, only 35,000 are waterfront properties. That's just 5% of the total inventory. Villas and townhouses are severely undersupplied. High-end branded residences in prime communities, same story. So when someone tells you Dubai has too much supply, the first question you need to ask is supply of what exactly? Don't treat Dubai as one market. Before making any investment decision, identify which segment you're actually buying into and whether that specific segment is oversupplied or undersupplied. Now, I've spent hours digging through transaction data and upcoming project reports to track exactly which segments are still seeing real demand. If you want early access to those insights, including verified off-market projects, join our private WhatsApp group using the link below. Now, you might be thinking, okay, but even if certain segments are undersupplied, isn't demand slowing down? That's the second misconception we need to address. What most people get wrong, and there's a narrative floating around that demand in Dubai is cooling off, that the influx of buyers is slowing and that the boom is over. Let's get started with this. Only 7% of Dubai's coastline remains available for future development, and we've already seen what extreme scarcity does to prices. Palm Jumeirah increased from 2,000 to 7,000 dirham per square foot. Blue Water Island rose from 2,000 to 5,200 dirham per square foot, and Bulgari residences in Jumeirah Bay jumped from 3,500 to 12,000 dirham per square foot. Hotel occupancy has also reached 78%. Reflecting sustained demand across tourism and residential sectors. Recent reports show a 20% increase in sales prices and 19% increase in rental rates, driven by population growth and economic expansion. And once again, villas continue to outperform apartments in price growth because this is exactly where demand is the strongest. So Dubai receives, on average, 100,000 new residents every year. And we're not just talking about average expatriates. Thousands of these are millionaires and high net worth individuals. 6,700 this year. These buyers aren't looking for entry-level apartments in developing areas. They're hunting for waterfront properties, villas, townhouses, and branded residences in established communities. Remember that 5% waterfront figure I mentioned? You've got thousands of wealthy buyers competing for a tiny fraction of the total inventory. That's not a recipe for a crash, that's a structural undersupply problem that isn't going away anytime soon. Focus on understanding who the buyer is for any property you're considering. If you're targeting the same segment that high net worth individuals are buying, you're positioning yourself in undersupplied territory. If you're competing with entry-level buyers, you're in oversupplied territory. Know which side of that divide you're on. But here's where Dubai fundamentally differs from other global real estate markets. Most investors assume that if there's a global economic crisis or geopolitical instability, Dubai's property market will crash along with everywhere else. I don't even need statistics for this because I see it every day. Around 70% of my clients purchase property in Dubai to diversify portfolios that were previously concentrated in Europe or the US. The Russian-Ukrainian situation triggered a wave of fear, not just among Russians and Ukrainians, but among Italians, British, Spanish, Eastern Europeans, and Northern Europeans who no longer feel their continent offers long-term stability. Latin American investors tell me the same story: political shifts, elections, and tax reforms, which have pushed them to look for a safe and predictable base. Clients from the US and Latin America specifically request gated communities and 24/7 security. Standard features in Dubai, but many ask for even more layers of safety because they no longer take domestic security for granted in their home countries. The reality is that safety is no longer guaranteed in many parts of the world, and for high net worth individuals, that's one of the primary reasons they shift their capital to Dubai. Dubai has positioned itself as the Switzerland of the Middle East, politically neutral, tax efficient, globally connected, and heavily marketed as a stable base for high net worth individuals. When instability rises elsewhere, safe haven demand spikes, pushing prices higher in premium segments, even when global markets are shaky. If you're investing long term, choose assets that align with Dubai's safe haven appeal, like branded residences, villas in gated communities, or properties in master plan developments backed by government-linked developers. And speaking of the future, there's a major factor that many investors either don't know about or completely underestimate. People look at areas like Meydan Horizon, Dubai South, or parts of Ras Al Khor and dismiss them as too far out or too long term. Let me give you an example. Dubai's master plan is designed to create multiple new urban centers to reduce congestion and improve connectivity, shifting growth outward from traditional hotspots like downtown and Dubai Marina. It also expands green spaces and upgrades core infrastructure to prepare for the population reaching 5.86 million people by 2040. According to the Rochester Institute of Technology, the master plan requires major upgrades to water, energy, and road networks, precisely the kind of infrastructure that acts as a precursor to long-term real estate viability in developing districts. So, under the Dubai 2040 Master Plan, massive infrastructure investment is coming to specific areas over the next decade and beyond. Take Meydan Horizon, for example. It sits right in front of Ras Al Khor, which has been designated a UNESCO World Heritage Site and offers what will arguably be the best downtown skyline view you can get. The area is getting metro connectivity and major development. Dubai South, positioned around the airport expansion, is another long-term play that's part of the strategic vision. But, and this is critical, these are long-term holds. If the market enters a consolidation phase, which it will eventually, these fringe development areas can stagnate for a minimum of 5 years before they start delivering returns. So long-term infrastructure plays can be incredibly lucrative if you have the holding power and patience, but don't confuse a 10-year investment with a 2-year flip. If you need liquidity or can't weather a prolonged consolidation, stay in established communities with proven demand. Which brings us to the uncomfortable question: when consolidation does come, who gets hurt? People think that in a downturn, good properties are safe and bad properties take the hit. But it's more specific than that. Between 2021 and 2025, Dubai saw an influx of 450,000 new residents, and many of them specifically targeted villas, townhouses, and family-sized apartments. This shift in demand has created structural pressure on these segments. I've seen buyers lose hundreds of thousands of dirhams by buying into these segments at the wrong stage of the cycle, while those in the scarce, family-oriented communities hardly felt the downturn. When consolidation comes, and it always does eventually, certain segments will lose value. Older stock in mature communities, lower quality standalone towers, long-term fringe developments, oversupplied entry-level apartments. Before buying anything, ask yourself, if the market cools tomorrow, who would still want to buy this property from me? If the answer isn't clear, you're taking on significantly more risk than you might realize. So if that's who loses, who actually holds value or even continues appreciating when everyone else is panicking? People think that all properties in a hot community will perform the same. They don't. Even during market consolidation, certain segments tend to hold their value or keep appreciating. Properties from high-quality developers, MR, Nakheel, and other government-linked developers have proven track records and built community infrastructure that retains value long-term. Waterfront properties with only 5% of inventory being waterfront, scarcity protects value even when the broader market softens. Villas and townhouses undersupply in this segment means there's less downward pressure, even during consolidation. Prime branded residences in established communities. High net worth buyers don't disappear during downturns, they just become more selective. They still want branded residences in places like Palm Jumeirah, downtown, or Emirates Hills. The key difference: these properties have structural advantages, scarcity, quality, location, or buyer profile. That insulates them when sentiment shifts. If you're buying for capital preservation rather than speculation, focus on these protected segments. Yes, you might pay more upfront, but you're also buying downside protection that cheaper properties simply don't have. Now, you might have seen recent headlines or reports talking about bubble risks in Dubai. So let's address those directly. When people see reports warning about moderate bubble risk in Dubai, they either panic and think everything is about to crash, or they dismiss the warnings entirely. The truth is more nuanced. Some market reports are flagging legitimate concerns. High supply pipelines in certain segments, they're right. Rapid price appreciation in some areas, potentially outpacing fundamentals, partially right. Speculative buying behavior, true in pockets, but they treat Dubai as one market. They don't distinguish between oversupplied entry-level apartments in developing areas and severely undersupplied waterfront villas in established communities. They also often miss the safe haven capital flows and the structural demand from high net worth migration, which creates sustained demand in specific segments regardless of what the average market is doing. So the bubble warnings are not wrong, but they're incomplete. There absolutely are bubble-like conditions in certain segments. There are also segments with strong fundamentals that can sustain current pricing or even grow. Don't ignore the warnings, but don't treat them as blanket truths either. Use them as a reason to be more selective and diligent about which specific segment and area you're buying into. The market isn't binary. It's not all safe or all risky. It's segmented, which leads us to the final point and arguably the most important one. Most people think you can only make money in real estate during a boom. When the market cools, they freeze and wait for the right time to get back in. I've had clients in 2021 telling me to wait because the prices in MR Beachfront were too high. The year after that, they told me the same thing, and look where we are now. Here's how professional investors think about it. In stock trading, you can short a stock or buy a stock. By choosing to buy one stock, you're essentially betting it will outperform others. You're shorting the alternatives. Real estate works the same way. By buying in a specific area or segment, you're making a bet on a relative performance. You're saying this will do better than that. Even during a market consolidation or downturn, some areas will decline by 30%, while others decline by 5% or even appreciate. If you can identify the segments that will hold value, you can still build wealth while others are losing it. The key is being strategic rather than reactive. Don't just buy anything that gets promoted to you. Understand the cycle, understand the segmentation, and position yourself accordingly. Focus on relative performance, not absolute market direction. Ask yourself, even if the broader market softens, why would this specific property in this specific segment hold value better than the alternatives? If you can't answer that confidently, you're speculating, not investing strategically. Now, it's one thing to understand what's happening in the Dubai market, but it's another to know what that means for your own portfolio or the next purchase. That's why I always recommend speaking directly with a market expert if you want to review your 2026 investment plan or see which areas will hold strongest in a consolidation. Book a private call using the link below. So no, the Dubai boom hasn't ended, it's maturing. But the next phase will separate the speculators from the strategists. If you want to see exactly which areas to avoid right now and why, watch this next video where I break down the worst areas to invest in Dubai.